Welcome to the Deep Dive. Today we're diving into the latest numbers from Alphabet Inc. That's Google, YouTube, Google Cloud, their Q2 2025 earnings analysis, ticker GODGL.
Yep, and our goal here is really to cut through the jargon, figure out what's actually driving the results in this report, and, make sense of how the market reacted.
Exactly. We'll be using our structured five-part framework, pulling together Alphabet's own data with real-time market info.
It's all about getting past just the headlines.
Right. You'll hopefully uncover some interesting nuggets and get a quick way to be genuinely informed about one of the world's most watched companies. Okay, let's kick off with slide 1. The at-a-glance scorecard. This gives us that top-level snapshot. How did Alphabet do against expectations? What did the market think straight away?
Well, they put up a really strong Q2, beat expectations on both revenue and profit.
Okay, so the numbers.
Total revenues hit $96.428 billion. That was quite a bit higher than the consensus estimate of $94.01 billion. So definitely a beat.
A clear beat on the top line. What does that signal?
It signals pretty robust, broad demand for their stuff, their products, their services. And it wasn't just revenue.
The bottom line, too.
Exactly. Diluted earnings per share, EPS, came in at $2.31. Wall Street was expecting more like $2.18.
So, beating on both top and bottom lines, that suggests, what, good sales and good management.
That's right. Healthy sales momentum combined with, effective operations.
Okay, so the big question, what did the stock do? GOGL.
In the immediate after-hours trading, it ticked up. Just a modest bump, 0.17%, but positive.
So the market liked it, confirmed the strong results.
Seems that way, yes.
And looking year over year, how does the core performance stack up?
Pretty impressive growth. Total revenue up 13.8% to that $96.4 billion figure.
Okay.
Net income jumped 19.4% to over $28 billion.
Wow.
And diluted EPS saw an even bigger jump, 22.2% increase, from $1.89 last year to $2.31 this quarter.
Hang on, 22.2% EPS growth, but only 19.4% net income growth. How does that work? Why the faster growth in EPS?
Good question. That difference isn't random. It's the result of a very specific capital allocation choice.
Meaning?
Well, remember, EPS is just net income divided by the number of shares. Diluted accounts for all potential shares. It's the conservative number.
Right.
Alphabet's diluted share count actually went down. It fell from about 12.5 billion shares in Q2 last year to just under 12.2 billion this quarter.
A decrease of about 2.4%.
Exactly. And that decrease comes directly from their share buyback program. They spent a huge amount, $13.638 billion, just buying back their own stock this quarter.
I see. So fewer shares outstanding means the same profit gets spread thinner, boosting the per-share number.
Precisely. It concentrates the profit, amplifies EPS, and enhances returns for the remaining investors. It's a key part of their strategy.
Okay, that makes sense. Let's move on. Slide 2. The engine of profitability. This is where we look at how efficiently Alphabet turns those billions in revenue into actual profit, margins.
Right. First, gross margin. That's profit before operating expenses. It actually expanded, moving up to 59.5% this quarter from 58.1% last year.
Suggesting better efficiency. Or maybe a shift to higher margin products.
Could be either or a bit of both. But then you look at operating margin, that's profit after all operating costs.
Yeah.
It stayed flat, stable at 32% for both Q2 2025 and Q2 2024.
Stable seems okay. But wait, you said something earlier. Does it mask something?
It does. That stable 32% is actually pretty interesting because it hides a big one-off expense this quarter.
Okay, explain. Revenue grew almost 14%, right?
Right. But look at their general and administrative costs, G&A. They surged, up nearly 65% year over year, from about $3.2 billion to over $5.2 billion.
Whoa, 65%. Normally that would crush the operating margin. How did it stay flat at 32%?
Well, the press release gives us the answer. It mentions the operating margin was, and I quote, partially offset by a charge related to a settlement in principle of certain legal matters.
Ah, a big legal settlement charge.
Exactly. And these kinds of charges, they don't get assigned to Search or Cloud. They fall into this bucket called Alphabet-level activities.
And that bucket's loss got bigger.
Significantly bigger, widened to a $3.37 billion loss from about $2.3 billion a year ago. So the point is, that reported 32% operating margin. It actually understates the core profitability for the quarter.
Wow, so if you stripped out that one-time legal hit, the underlying margin would have been even stronger.
Precisely. Without that non-recurring charge, you'd see positive operating leverage. I mean, look at other big costs like sales and marketing. They only grew 4.5%, much slower than revenue.
That really highlights the strength of the core business then.
It does. Shows the underlying efficiency.
This brings up GAAP versus non-GAAP. Can you quickly touch on that? Like constant currency figures.
Sure, GAAP is the standard accounting rules, but companies often give non-GAAP numbers for clarity. Alphabet provides constant currency revenue, which is non-GAAP.
And that helps how?
It takes out the effect of changing foreign exchange rates. So you see the underlying business growth without currency swings messing with the numbers. For Q2, reported revenue growth was 14%.
Okay.
But on a constant currency basis, it was 13%.
So a slight benefit from a weaker dollar this quarter.
Exactly, a small tailwind. Important context for a global giant like Alphabet.
Got it. Okay, let's move into slide 3. The engine room business segment performance. Here we break down the total results and see how the individual parts are doing, the key drivers.
Right, dissecting the machine.
First up, Google services. The big one, search, YouTube ads, Android. Still the powerhouse.
Absolutely, still the financial bedrock. Revenue there grew a very solid 11.7% year over year to $82.5 billion.
And profit.
Operating income up 11.4% to $33.1 billion. The operating margin stayed incredibly high and stable at 40.1%.
40% margin on that scale is huge.
It's immense. This consistent, massive profit engine is what allows Alphabet to fund everything else, especially the riskier bets. It's the cash cow.
Okay, now for Google Cloud. You mentioned this was a standout, the profitability inflection point.
Yes, this was the big story this quarter, I think. Cloud revenue growth was impressive, up 31.7% to $13.6 billion. Strong growth.
But you said the real story was the bottom line.
Absolutely. Cloud's operating income surged, up a massive 141.1%. It went from $1.17 billion last year to $2.83 billion this quarter.
Over double the profit.
More than double. And that caused its operating margin to explode, basically, from 11.3% last year to 20.7% this quarter.
20.7% margin for cloud. That's a huge jump. What's the significance here for the bigger picture?
It's critical. This signals Google Cloud has hit an inflection point. It's reached the scale where it generates serious operating leverage, meaning profits grow faster than revenues.
So it's not just growing fast, it's becoming really profitable.
Exactly. Sundar Pichai, the CEO, pointed this out. Cloud's now on an annual revenue run rate over $50 billion. Demand for their AI services is strong. This changes the whole investment story for Alphabet. Cloud is now a powerful second engine for both growth and profit.
A true second engine. Okay? And quickly, the other bet segment. The moonshots like Waymo, Verily.
Right, the long-term bets. As expected, minimal revenue, $373 million, and an operating loss of about $1.25 billion.
Which is normal for this segment.
Completely normal. It's an incubator. Investors see these losses as R&D for potential future breakthroughs. Financially, it's negligible to Alphabet's overall results right now.
Makes sense. Okay, slide 4. Financial strength and shareholder rewards. Let's look at their balance sheet health, capital structure, and how they're spending their money.
Alphabet's balance sheet is, well, famously strong, one of the best out there.
Why does that matter so much for you, the listener?
Well, look at their debt-to-equity ratio. It measures leverage. It's incredibly low, 0.38 as of the end of June. Minimal reliance on debt, very low risk profile.
And cash. They always have tons of cash.
Astounding amounts, $95.1 billion in cash, equivalents, and marketable securities at quarter end.
That's a massive safety net.
Huge cushion. Funds operations, investments, weathering storms, gives them immense financial flexibility.
And they're using that flexibility. You mentioned their capital allocation investing for growth and returning cash to shareholders. How did that play out this quarter?
Big outflows on both fronts. For growth, CapEx, that's spending on property and equipment, think data centers, was $22.4 billion.
$22 billion in one quarter? That's huge.
It is, and it's up 70% from last year. Signals a major investment cycle is underway.
And shareholder rewards.
Also huge. They returned over $16 billion, about $13.6 billion in buybacks, and $2.5 billion in dividends.
Okay, so let's add that up. $22.4 billion in CapEx, $16.2 billion in shareholder returns. That's nearly $39 billion going out.
Yeah.
How much cash do they actually generate from operations?
That's an interesting part. Cash from operations was about $27.7 billion.
So they spent way more 38.6 Bs than they generated,
Right.
$27.7 Bs. How they cover the difference? Dipping into the cash pile.
Not just that, they strategically used their strong balance sheet to borrow money. The cash flow statement shows they raised almost $27 billion from issuing debt, net of costs. And the press release mentions a specific $12.5 billion note issuance in May.
So they're taking on new debt, even with $95 billion in cash, to fund both massive CapEx and huge shareholder returns. What's the thinking there? Is that confidence or
It screams confidence. Management is so sure about future prospects, especially in AI and cloud, that they're using low-cost debt, which they can get because their balance sheet is so strong, to fund this massive investment opportunity.
A once-in-a-generation opportunity, as they see it.
Seems that way. The CEO's plan to boost 2025 capex to around $85 billion confirms it. They're not choosing between investing and rewarding shareholders. They're aggressively doing both at scale by tapping the debt markets, weaponizing the balance sheet, essentially.
A bold strategy. Okay, final section, slide 5. The road ahead management's outlook and key takeaways. What does this all boil down to for you, the learner?
Management's tone was definitely upbeat. CEO Sundar Pichai's comments in the release talked about broad strength, confidence, particularly around AI.
He said, we had a standout quarter with robust growth across the company.
Yes, and he really hammered home the AI point. We are leading at the frontier of AI and shipping at an incredible pace. AI is positively impacting every part of the business.
Driving momentum, he said. And he highlighted cloud again.
Yep. Strong growth in revenues, backlog, and profitability, and hitting that $50 billion plus annual run rate.
And the investment signal for the future.
Very clear signal of heavy investment, increasing the 2025 capex forecast to about $85 billion, driven by cloud and AI demand. He said they're excited by the opportunity ahead.
Okay, so let's synthesize. What are the really critical themes from this Q2 analysis?
I think there are 4 key takeaways. First, cloud's profitability inflection is real and significant. That massive jump in operating income and margin proves it's a powerful second engine, strengthening the whole investment case.
Second,
Core business strength absorbed those headwinds. That solid 14% revenue growth, mainly from search and ads, let them swallow that big legal charge without blinking. Shows the resilience of the core.
third theme.
Aggressive investment in AI is clearly the overarching strategy now. That $85 billion capex plan is huge. It'll hit free cash flow short term, but they see it as essential to dominate the AI era.
And finally, number 4.
Shareholder returns are being amplified by that fortress balance sheet. They're smartly using cheap debt to fund the huge capex and return billions via buybacks and dividends. It's a powerful dual commitment.
So putting it all together, this strong quarter wasn't really a surprise, but more the result of a strategy firing on all cylinders.
I think so. Cloud profitability accelerating is the big new piece. That, plus the incredibly strong core Google Services business, generated enough profit to overcome the legal charge and still deliver impressive growth.
And the path forward is clear. Invest heavily, funded by that balance sheet, to win in AI while still rewarding shareholders.
Exactly. Confident, aggressive investment is the narrative. They're building the infrastructure for the next computing era, they believe, and using their financial power to do it without compromising shareholder returns today.
So for you listening, analyzing earnings like this, using a framework,
It lets you get beyond just the headlines, right? You can see the real performance drivers, check the financial health, understand the outlook. It's repeatable.
and thinking about this quarter, maybe consider how this massive debt-fueled AI investment might ripple through the tech landscape. What does it mean for competitors? For the future of the cloud itself? Lots to chew on there.
Indeed. Okay, before we wrap up, the necessary reminders. Please remember, this deep dive is for informational purposes only. It does not constitute financial, investment, legal, or tax advice.
All investment decisions should always be based on your own research and in consultation with a qualified financial professional.
And note, this report was generated by an artificial intelligence model, integrating data directly from Alphabet's official earnings press release with publicly available market data. While we strive for accuracy, errors or omissions may occur.
So please, independently verify all information.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.